Welcome to the Cardinal Commentary for the Canadian Equity Portfolios. The Bank of Canada raised interest rates by 50 basis points in late October. That's the sixth hike this year, taking the bank's key interest rate from 0.25% to 3.75% since March. It's one of the fastest monetary tightening cycles in the bank's history. But there's a method to what some of us see as the madness. The bank raises rates to keep inflation from spiraling out of control. The risk in doing so, however, is triggering a recession. Many observers believe that a recession is inevitable, but remember, they happen regularly, usually every 5 years or so, and are a part of the regular business cycle. Hearing about a recession can be difficult for many investors, as the S&P TSX is down more than 13% since the spring. We believe in never letting a good crisis go to waste, and market downturns can be a great time to invest. Portfolio manager Terry Wong says he finds two of Canada's big five banks, BMO and CIBC, particularly attractive right now.
Well, a couple of banks that we own in the portfolio is Bank Montreal and CIBC. Obviously, there are other banks that we own in the portfolio, but again, these companies that we own, they have a long history of being in operation. They have a long history of doing well during good times and in bad times, and they have a long history of earning and growing and paying the dividend, and that's what's important.
Both banks have been rocks throughout the pandemic and continue to grow their revenues, earnings, and dividends, while some of their international counterparts have either cut or suspended their dividends. BMO's dividend history, in fact, dates back nearly 2 centuries to 1829, the longest of any company in Canada. CIBC, meanwhile, has continued to pay out dividends since 1868, more than a century and a half. These two banks have helped the Cardinal Canadian Equity Portfolios churn out above average returns over the last 12 months, 4.1% versus negative 5.4% on the S&P TSX, and over the last 25 years, 10% versus 6.6% for the benchmark. Put another way, if you had invested $100,000 in the Cardinal Canadian Equity Portfolios in 1997, it would be worth nearly $1.1 million today. But regardless of what's going on in the economy, portfolio manager Sheila Wilson-Cole says it's crucial for investors not to veer from their long-term strategy.
You have a good strategy in place and you stick to that strategy. You invest in good quality companies, ones trading at a reasonable valuation, companies that you have confidence in. That portfolio grows over time and it will double with time and then go on to double again.
It's far more important not to miss out on the bull markets than trying to avoid the bear markets. And why do we do all this? Because it works. And that's the Cardinal Commentary for the Canadian Equity Portfolios. Thanks for joining us.